Hi guys, in this video I'm going to talk about the first steps of the protocol, what we call System Initialization Protocol. So I will refer to it as SIP, and this is the foundation block of every trader in my opinion. Alright, so first and foremost, I always want to start with a roadmap of my presentation because I found this to be the best way to present and for you to learn and absorb because you know where you are at every point of the video. So this video is divided into 6 parts: why SIP exists, then what SIP is, then we will look at the 4 pillars of SIP. We'll go over the concept and examples of each pillar, and then I will give you a pre-session checklist to make sure you are on point before you even open the charts. And then finally a conclusion and what is next. So your setup was perfect, but the trade still lost. Most traders lose money not because they can't read a chart, but because they fail to understand the environment they are trading in. Sometimes you have a setup, the setup looks good, you take the trade, but the market just doesn't move or simply moves against you. So this is why the System Initialization Protocol exists, because even before opening a chart, you already have a filter in place to help you select the best and highest probability days to look for a setup. Then the second point, what is SIP? SIP is the process to understand in what kind of environment are we in right now. Let's try to think of an example. Imagine let's say you are about to surf. Imagine you're a surfer. You wouldn't just paddle out and start surfing without looking at the ocean first, without looking at the weather first, without looking at the overall context. You would check, are there good waves today? Or is a storm coming or whatever. Same thing here. So you want to be looking at the markets when the environment is right. So in a wrong environment, you can have your perfect setup with a sweep, an inversion, whatever, and have poor results. If you trade in the right environment, even your decent setups, you're not A+ setups, but even B, they still provide you the results. So here your edge is knowing the difference between a wrong and a right, correct environment to trade. So here we have the 4 pillars of SIP. First one is the economic calendar, then the difference between low and high resistance liquidity runs, and not only knowing the difference, but also knowing when they occur. Then intermarket relationships, which means using correlated or inversely correlated assets to help you clear the context. And then finally the type of market and seasonality that the instrument or asset you're trading is in. And all of these are checked periodically. For instance, I check the economic calendar for the week on a Sunday, so I know what to expect for the week. Intermarket relationships, I check this much more often, multiple times a day, to always be on spot, to always be aligned with current market pricing. So the economic calendar is the first thing I open on a Sunday when I start doing my weekly analysis. I don't look at the chart first, I look at the economic calendar for the week. So first of all, why is the economic calendar important? This is a bridge between your chart, so your price action over time printed in candles, and your macroeconomic data that come out periodically, and they're used for measuring the pace of the economy from many different sectors and perspectives. It's usually advised to size down or sit out around the announcement window to avoid any bad surprises. Some high impact news you want to keep in mind are your CPI, FOMC, NFP, and when the chair of the Fed speaks, and I would say even when Trump speaks. Most of the times lately, some crazy manipulations have happened during Trump speeches, actually before of Trump speeches. And this will help you to know when to sit out as well. Second pillar is the difference between low resistance liquidity run and high resistance liquidity run. So first of all, you want to be trading during periods of low resistance liquidity runs. When price is going to move from point A to point B, it doesn't always move the same way. Sometimes it just goes clean, smooth, one direction. Other times it fights, it chops. It moves 2 steps forwards, 1 step back. It looks like it's going somewhere, but it's really just grinding. Or what ICT calls seek and destroy mode. So the difference between a clean move and a choppy one is the difference between a low resistance and a high resistance liquidity run. So this is the drawing example. When you have clean, smooth, one direction, probably here there are imbalances that are respected and price is trending very well. And then when price changes its direction, then they all become target. It all becomes liquidity to get taken very easily, to get run through. For high resistance, you can see that high is taken, but it fails to hold and be used as support, and price run back down, take the lows, come back to the middle of the range, come back down, the trend is not supported, there's another change of direction, back to the highs, takes the highs, just sweep them, reverse, it's choppy. Here you need to be defensive, so having shorter targets or even just stay out because these conditions are coming. And this is just an example, all right, of high resistance liquidity run, price run up, fails to find support here, finds initially, then reverse, go back to the lows, reverse to the highs, go back to the lows, back to the middle, go back to the lows once again, break, but doesn't find resistance here, and so comes back up, chops around. For low resistance, we have accumulation here, we break, then this fair value gap holds once, holds twice, there's another run down, and then price changes direction. There's a impulse higher, closed above these highs, inside this imbalance, changing state of delivery as ICT calls it, retracement, reaccumulation, and then price starts trending, respecting bullish PDR raise, bullish levels. So here we are respecting this imbalance, here as well, respecting this imbalance, come higher, taking out the targets. Whereas here, again, we respect this for value gap, try to respect this one, come down, break down with an inversion, failed, reverse, for value gap, broken, so on. The third pillar of our system initialization protocol is intermarket relationships. The concept here is any instrument you want to operate in and analyze and dissect, you need to have at least one other correlated asset, whether it is positively correlated or inversely correlated. The main concept is we can say that asset one is the Nasdaq futures in this example, so NQ, and asset two here is S&P 500 futures. So yes, this direct correlation allows you to see when one asset is ahead of the other, when one is lagging behind, and also when one of them is lying in the direction it's going. Inversely correlated, you can keep asset one being NQ and asset two can be the DXY, so the dollar. And here we have a spectrum because the extremes are not populated. So what I mean is there is not perfectly correlated or perfectly inversely correlated assets. There's a spectrum. So NQ and ES are probably somewhere here, very similar, very correlated, but NQ and the DXY, they're like here. They're not towards the extreme. And then finally, the last pillar I want to touch on is the type of market and the seasonality. So this is also a very important component to initialize these systems because you need to know the type of market you are operating in. And right here, I always mean higher time frame, but this can also be applied to lower time frame as well because everything is fractal. That's the name Fractal Labs for a reason. So we see on a trending market, price respects one side. We can zoom, respects one side of the market. So we have an impulse, pullback into an imbalance, impulse, reaccumulation, impulse, imbalance, used as support here, higher reaccumulation again, one more impulse, and so on. Ranging, you can tell this is a pretty range looking market. And then there is transition, that is a phase that you're not really trending anywhere because you have had an expansion lower in this case and a retracement higher to more than 50%, and now wandering around 50% of this leg down. You are transitioning here. You could either accumulate and attack the high, or accumulate and continue this higher trend, which is more probable, and come down once again. Then seasonality. This is very important for any asset you are trading, especially for the ones that are more seasonals. I'm thinking more about energies or like oil or cotton, or but still even NQ and gold have their seasonality. So if you see here with this gold chart seasonality, you can see a big push start of the year, January and February pretty much all straight. March usually a period of accumulation, and then starts a second leg, a second expansion during April, so start of Q2, and then a accumulation slash retracement for the summer months, and then Q3 to Q4 just straight up for gold. So you know that if you're trading in May and in June, you gotta be careful and you don't wanna hold. So if you're looking for longs here, because nobody is telling you that you cannot look for longs or shorts in any of these, all right? You can look for shorts anytime. Here you are more careful with holding your trades longer and maybe take a couple more shorts setup compared to maybe your first 2 months of the year. This is the end for the 4 pillars. Now we move on to the SIP pre-session checklist. This is not, when I say session, I don't mean London session or New York session, analysis session, all right? So before your chart analysis, you gotta know what's on the calendar today, all right? What environment we've been in, low or high resistance, and what environment do I expect for the day or days that I'm looking for trades. What are the correlated markets doing? Is DXY confirming? It's something important you have to keep in mind. And then what phase is the market in? Is it trending? Is it ranging? Is it transitioning? Do you have to sit in your hands? Do you have to actively looking for a trade? And here you have the result, which is trade with the current, not against it. Your friend is your friend for a reason. Know when not to trade is very important, even more than knowing when to trade. This gives you higher confidence on every entry because you know the best context conditions to look for your setup. And finally, consistent conditions equals consistent results. This is the SIP module roadmap. There are 5 videos, and each of them from now on will go deeper into each pillar. So on the next video, we will talk exclusively about the economic calendar, and then low versus high resistance liquidity runs, and then intermarket relationships, and finally type of market and seasonality. I hope you enjoy your video. Thank you for your attention, and please like and subscribe. And I hope you have a nice day.